So it's summer. The 4th of July is next week, and Americans are in full travel mode. And reports from airports, well, they're not pretty. Our family has driven from Des Moines, Iowa to Breckenridge, Colorado almost every summer for the past 20 years, 747 long miles, sometimes with very small children. One feature of summer car travel is the dreaded road construction area. Signs announcing miles of single-lane traffic on the interstate, slowing things way down. On the way from Iowa through Nebraska, finally to the Colorado Rockies, one thing is for sure, you're either just coming out of road construction, it's in front of you, or you're in it. It's a cycle about summer travel that we're always experiencing some kinds of road construction around us. If only Google Maps, which is pretty helpful with summer road travel, could help us with economics and bear markets. The economy and markets are a little bit like summer car travel. There's a recession and or a bear market in the rearview mirror. You're either in one or there's one right around the corner. We just can't see when. For investors, you're either in a down market or a recovery in a growth market. Markets and economies, they do run in cycles. And as much as we wish for simple, steady growth, the world has never worked quite that way. Slowdowns are happening currently. The Purchasing Managers Index that came out last week showed a global slowdown as central banks around the world signaled their ongoing tighter monetary policy, especially higher interest rates as they try and slow down the rapid rise in the rate of inflation. U.S. retail consumption declined about 0.3% in May. Existing home sales declined as well as 30-year mortgages rose to over 5.8%, the highest since 2008. This even as the average existing home sale price reached record highs. The Fed indication that they would raise rates until they saw inflation abating continues to influence other rates as well. Here you see the 2-year Treasury now over 3%, while it started the year under 1%. And as I mentioned, the 30-year national average for home mortgages has climbed to 5.18%. All of this news would suggest a slowing economy, which to a point is what the Fed wants. The goal is to slow economic growth enough to bring inflation down while not going into a recession, commonly defined as 2 quarters of GDP contraction. Recessions threaten employment gains, which is the other stated priority of the Fed. Stable prices, not inflation, and full employment. Now, whether the Fed has enough power to accomplish that soft landing, lowered inflation without recession, is debatable. Supply chain constraints, the ongoing war in Ukraine are all major contributors to the inflationary pressure, and the Fed really doesn't have direct control over those kind of events. So all of that economic news has created a less than positive environment for stocks and bonds. Stocks respond negatively to economic slowdowns, and bond prices respond negatively to rising interest rates. Bear market readings for the broad U.S. stock market have fallen more than 20% from the previous market high, which was reached on January 3rd. That bear market point was reached on June 13th. U.S. stocks continue to fall in the first half of June through Thursday, June 16th. It's feeling like road construction with lane closures slowing down just about everything. The last week, the narrative changed a bit, with Fed Chair Jerome Powell talking about both fighting inflation and staving off recession. Investors began to wonder if the Fed will not be able to raise rates as high as originally predicted. In a bad news might be a good news story, a slowing economy, which may be in part due to those higher prices, stock investors are seeing maybe a silver lining. Whether we are really at the end of this latest construction slowdown, well, that remains to be seen. Bear markets or slowdowns when the U.S. stock market falls broadly by 20% or more. These have occurred now 13 times since 1946, so about once every 5 to 6 years. But even though they are recurring, they vary broadly in length, in depth, and in the space between. The most recent bear market before this one, the pandemic, reached its low point in a record of 1 month. The bear market of 2007 to 2009 was a protracted one, taking 54 months to get from one peak to the next. Bear markets are very hard to predict on any kind of time scale. Like road construction on a long car trip, you have some in the rearview mirror, you might be in one, and there are certainly more to come, all of which will be varying in length. But most of the time, we're not in a bear market. Most of the time, stock investors are in a time of recovery or a bull market, marked by gains more than losses. With all the talk about a possible recession, it can be helpful to look at a bit of history. From 1945 to 2020, the U.S. economy has seen 12 recessions, lasting an average of just over 10 months each, and expansions lasting an average of just over 64 months. Again, longer periods of positive growth versus those negative periods of economic contraction that are in between. Here's an important point, though. The economy is not the same as the stock market. They're related, but not identical. There are correlations between recessions and bear markets and vice versa, but not clear causation. Just look at the date ranges on the table here. 6 times a bear market for stocks has anticipated or started before the official start of a recession. That's the blue numbers. 2 times a bear market followed the start of a recession. So kind of a lagging indicator in that period. 3 recessions didn't see an overlapping bear market at all, and 2 bear markets didn't see an overlapping recession at all. What this tells us is that, yeah, they're kind of related. There's a correlation there, but in terms of causation or something we can use to predict what's coming next, bear market, recession, which comes first and how long they're going to last, it looks to me like the data is pretty unpredictable. And that's what most financial economists have come to conclude as well. There's no official recession announcement yet because the economic data is not clear as to the second quarter's GDP contraction or growth. But we have entered a bear market with the S&P down by as much as 23% before last week's recovery. Whether that will prove to be the bottom after just 6 months, well, that's anyone's guess. The world is really far more complicated than a single cause. Think about the current bear market related to a war, which has consequences for energy and food globally, inflation related to post-pandemic demand and supply problems. This was all wreaked by a pandemic virus that shut down economies, caused record high unemployment, and saw the greatest surge in government spending and transfer payments ever in the United States. So what does all this mean for investors? Well, for long-term investors, we think it is interesting information that should not deter diversified investors from being optimistic about the longer-term future of the U.S. economy and the U.S. stock market as well. This chart simply shows the growth of the S&P 500 from 1950s through Friday. The gray bars are the recessions, and you can see the volatility of the market, the purple line around those recessions. What the big picture says, though, is that the long-term diversified stock investor did extremely well by staying invested throughout. When a total portfolio is constructed of a mix of cash, bonds, and stocks, such that an investor never finds themselves having to sell stocks during bear markets, that investor benefits from uninterrupted compound growth. Here's that same chart, but this one better illustrates the potential growth of a long-term investor's portfolio dollars. Here in compounding, the growth of a single $10,000 investment in the U.S. stock market from January of 1950 through June of 2022 came to $2.3 million of appreciation in 72 years. Those are Warren Buffett-like results. Let's just shorten that up a bit, though, to the last 50 years, about the time frame many investors could be accumulating for retirement in the first decade of retirement withdrawals. The first $10,000 investment over that 50 years could have been worth $365,000 just by staying invested through recessions, through bear markets, through expansions, through contractions, and all different kinds of political environments. I wish there was a sign saying how much more market and economic construction we must go through before it's over. But like our summer drive to Colorado, we'll keep going because we know that the lane closures will ultimately end, flow of traffic will speed back up, and that'll allow us to get to our destination. So our advice continues to be diversified, stay invested, and try to enjoy the trip.